Good morning everyone and welcome back to Morning Markets here at True Potential. Today, a quick comment on broader markets, but we're going to do a bit of a deeper dive into the UK's market reaction to yesterday's CPI print. So a stronger day for markets again yesterday. Equity markets positive and the bond market was positive, which meant yields on government bonds actually fell. Main cause of this was the positive surprise for UK inflation in the UK. Now, my colleague George Bell yesterday gave you some information on the composition of that print, but let's dive into it a bit more and help you understand why it's important. So there was a downside surprise yesterday. So that is inflation in the UK came in lower than analyst consensus had expected. This is important because, as we know, UK inflation has persisted higher and for longer than in other markets such as the US and the Eurozone. And just as encouragingly, within the basket of inflation, within the individual components, all of these showed a decline in price pressures. And in fact, things like transport and fuel actually showed a fall in prices. That is, inflation year on year in that individual component is negative. And the ONS actually gave a comment that there were no offsetting large price pressures. So everything broadly is declining in price pressures. The growth rate is slowing in inflation. But we would caution that this is just one print. So this is not enough for there to be an end to the cycle of increases in base rate that we've seen over the last 18 months. And in fact, we do expect that the Bank of England will raise base rate by another quarter point at their scheduled meeting in 2 weeks. However, we need to see more of these types of inflation surprises over the rest of the summer and into September for the bank to materially alter their language. So whereas yesterday we did have a positive reaction from markets, particularly in the UK bond market, an additional rate hike towards the end of the year was priced out as traders moved to expect base rate to actually not finish up towards 6%. But markets do expect that the Bank of England will have further increases in base rate in the pipeline, a quarter point in 2 weeks and probably another one in September. So we do need to see these price declines, this slowing in the price growth rate to continue in the UK for the bank to materially alter their language. Of course, the one thing which is slightly compromising this is the wage data that was discussed with you by our CIO, Jeff Casson, last week. Wages in the UK, on average, are growing by around about 7%. That's just not compatible currently with a 2% inflation target from the Bank of England. So policymakers will be hoping that the slowing in price pressures will soon feed through into a slowing in wage growth. And that would be more commensurate perhaps with an inflation target of 2% towards the back end of next year. But it's a first step in the right direction. And please do join us on tomorrow's Do More With Your Money show, where we'll build out more on the impact of this surprise inflation print for the UK. So that's all for today, but please join us tomorrow for another update on markets. Thank you.